FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is 5/13/20. Well, this person you're about to hear from has been preparing for a collapse probably longer than I have, and that's hard to believe because I've been preparing for it since, well, I don't even want to tell you because you'll think I have a tinfoil hat on, but I want to know what you've been doing to prepare for the collapse and the next one, which inevitably will occur. You can email me, kl@kerrylutz.com, kl@kerrylutz.com. Michael Pinto is with us now. And Michael, it is always great to have you on. You've been warning us about the inevitable collapse that finally hit. It just came in the form of a pandemic, but really It's here. And where do we go from here?
Well, a lot of where we go from here depends upon the virus. So just to briefly touch on that, I know I'm not a virologist, and I don't think you are either, Kerry. But they're saying that there's going to be a vaccine in the next few months. They've rapidly expedited the timeline for a virus. Normally, for a vaccine, a virus vaccine takes years to consummate and bring public. But now they're saying maybe, by Christmas or very early in 2021. What I find interesting about that is that the Wuhan virus is a coronavirus, and coronavirus is very similar to SARS, MERS, Middle East Respiratory Syndrome, and also the common cold is a coronavirus. But there's no vaccine for any of those viruses. So as to why there's no vaccine for those viruses and why there's going to be one for COVID-19 and how are they going to know it's safe in just a few months is beyond me. So my baseline scenario is that we do not have a vaccine until sometime well into 2021, which means we're going to have a depression, which I did predict in very early 2020. The model that I have, the 20-point model, indicated that we're in for some serious trouble early on by January 24th, which is why our portfolio was spared much of that decline. As a matter of fact, we are positive for 2020. But the point here is that if we don't have a vaccine, we don't have a viable treatment, then we're going to have a depression morph into a serious recession, because that's it. Now, on the second derivative basis, that's an improvement, and I'm sure for CNBC, they'll be cheering from the rooftops. But as to why or how that justifies a market that went down 30% in a straight line in a matter of days and now is almost completely back to where it was. In fact, the NASDAQ is positive for this year. There's a trenchant and yawning gap between the reality of where the market is and where it's going and asset prices. And of course, Carol, we know exactly who to blame for that, and that is Mr. Powell and the Federal Reserve.
Right. And now we're in a unique situation. We actually have helicopter money. That's what the PPP is about. That's what the stimulus is about. That's what the SBA EIDL disaster loans are about. They're just dumping money into the system. The enhanced unemployment benefits, which now make it much more profitable for you to stay home than to go back to work. All these things here, Michael, that we never, we suspected would happen, but we never really believed it, I guess. But here we are.
Well, they told us that we were morons for believing that the Federal Reserve would ever monetize debt. Remember, Mr. Fisher from the Dallas Fed said the Fed will never, ever, 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 ever print trillions of dollars like they do in Zimbabwe or, Argentina or Weimar Germany. We'll never monetize debt. Well, we went from $800 billion balance sheet in 2008 to $4.5 trillion. We drained a few dollars from that. Remember, we were pretending we could raise rates and perform quantitative tightening and consummate that down to around $2 trillion balance sheet from where it was. Well, guess what? Well, now we're at $6.4 trillion, heading to $10 trillion on the balance sheet. And we're not just monetizing Treasury debt, we're now buying junk bonds. In fact, the Fed started today buying investment-grade bonds and junk bonds, which is, in my opinion, especially when you compare it to the initial charter of the Federal Reserve, illegal. Well, they have no right to manipulate markets to the degree which what they're doing now. They're falsifying asset prices at record proportions. And like you said, they are engaged in helicopter money. So not only expanding the balance sheet to buy treasuries from banks, they're actually making loans to businesses in the primary market. Yeah. They're sending money, the Treasury sending money out through the CARES Act or PPP program, sending money, enhanced unemployment, sending checks. Now, I don't know. Here's a question for you, Kerry. Why would we pay a small business money so they can keep their staff on payroll and then send those same people $1,200 in the mail that didn't lose a job? I mean, where did this come from? And here's another thing. I talk about bizarro world. We learned today that the year-over-year consumer price inflation was up 0.3%. The month-over-month CPI was 0.8% in April. So you have a Fed that has gone, that blank crazy, printing trillions of dollars, handing out money via the helicopter, and month-over-month inflation is down the way they measure it, 0.8%. I guess NASDAQ stocks aren't part of the inflation calculation from the BLS.
Yeah, it's breathtaking. At least in 08 and 09, they sterilized the new money, so it never went down to the people. It went to the banks, and then they deposited excess reserves with the Fed at 25 basis points, guaranteed no risk return. And everyone was happy. All the banksters got to stay and keep their jobs and increase their bonuses. And this time they realized, hey, if we don't give money to the little people, at least pretend to, we're going to have a revolution on our hands, and hence the helicopter money, right?
Well, I mean, let's just be honest here. The deficit for Q2 is going to be $3 trillion. I was in the vanguard calling the deficit as to what it was for the year, $4 trillion. That was my prediction. Now the CBO back then, when I first made that prediction, said it was going to be about 1.6, 1.7 trillion. Now they're all on board. Everybody knows that it's going to be a $4 trillion minimum, $4 trillion annual deficit. That's 20% of GDP. And by the way, this kind of deficit has no productivity to it at all. Kerry, we're not building anything. We're not creating any kind of capital here. We're just handing checks out to people. And like you said, they pay interest on excess reserves to keep the money locked up into the coffers of the Federal Reserve. So they didn't really want inflation back in 2008 in the Great Recession. What they wanted to do was rescue banks. Hey, here's your mortgage-backed security that's going bankrupt. I'll take that from you, give you some credit. Maybe you'll gamble some of that in the stock market or buy some bonds, but most of it is going to be remain fallow at the Federal Reserve as excess reserves. And now this time around, they're doing all of that stuff and more. They're buying CLOs, they're buying junk bonds, they're buying mortgage-backed securities, they're buying all kinds of asset-backed securities. But as you said, they're doing a runaround of the banking system. They're also circumventing the banking system and sending money directly to people and businesses. So in other words, instead of just building the base money supply, which is physical currency and Fed credit, they're building the broader monetary aggregates, M1, M2, and M3. So I think this go around, especially now that we're hearing that Nancy Pelosi wants to do another $1 trillion stimulus package, because what we've done already, the $8 trillion we've done already isn't enough. We haven't even spent it yet, but we need to make sure that we, can go back to our constituents and say, that we wanted to outspend Donald Trump, who's doing a great job of spending on his own. So now we're going to have massive stagflation in the future, in my opinion, because we are creating a massive amount of debt, no productivity value ascribed to it, and we're also sending the broader monetary aggregates higher. This is something we cannot compare this to any other time in history, not the Great Depression, not the Great Recession. This is unique. It's unusual, it's unique, and it's going to have its own set of outcomes.
Yeah, and that's what scares me. Right now, okay, things are kind of starting to open up. Here in Florida, most of the state is opening up, and basically, I think the population is going to pull an Elon Musk and just say, we're not listening to you anymore. All right. The thing is run its course as much as it's going to. and we're going back to work, whether you like it or not. And you see more and more of this happening, more demonstrations, all these things. And really, what choice do people have?
Well, I mean, the choice that people have is they could, embrace libertarianism. It would be wonderful. We actually had a balanced budget, and we actually want to deal in reality. But that's not what we have, Kerry. We have. Let's see. Let's just go back into some history. So, remember in 2018, stocks plunged. Okay, and they were down about plunged. They were down 7%. The fourth quarter of 2018 was very bad. We're down about 20% in that quarter. But for the year, they were down about 7%. And earnings per share during that year was up 20%. Well, what was the reason why stocks were plunging in 2018? It was because of what the central bank was doing. They were printing money. I'm sorry, they were engaged in quantitative tightening, and they were raising interest rates. In 2019, stocks absolutely surged. What was the earnings per share back then in 2019, previous year? 1%. 1% increase in S&P 500 earnings per share. So we've gone from this bizarre world where earnings don't even matter anymore. We only have to ask ourselves one question. The salient question is, what is the Fed doing? What is the ECB doing? What is the Bank of Japan doing? What is the PBOC doing? That's the question we have to ask ourselves, not what the earnings are any longer. And that's very, very sad because, in my opinion, capitalism has been eviscerated. There isn't any market indicator any longer. You used to look to the yield curve as an indicator. Say, well, what's the spread between the 2 and 10 Treasury? Well, you don't really look at that anymore because the Fed is in there. Well, what about the high yield spread, the spread of high yield bonds over Treasuries? Well, the Fed is buying both those things right now. So, I mean, where do you really look anymore? LIBOR, we know, is manipulated. So, what do you look at? Stock prices? Where's the free market indicator any longer? I believe central banks have eviscerated capitalism, and that's the saddest thing of all.
Really, it really is. And we never thought we would live to see this day. But I guess in many respects, you and I know that there was a certain inevitability about it. And like you say, there is no free market. There's only interventions. I mean, we look, food producers were shutting down, so Trump basically nationalized them through the Defense Act and Production Act, right? And basically any sector of the economy starts heading down, and there's a massive charge to bail it out. Look at the airlines, look at Boeing. I created something called the Taxpayers Bailout Bill of Rights. And the first thing they should do in those companies that have to go for a loan, the ultimate bailout, is they need to fire the management there. Boeing bought back $45 billion worth of stock since 2012. The airlines themselves bought back another $45 billion of their stock. And then they can't figure out why they don't have any money to weather the storm. I mean, there's something wrong here.
Kerry, people that listen to people like us, sometimes they might think that we're kooky, we're crazy. But, we've been warning about this for quite a long time. Let's just look at, you talk about stock buybacks and you think about, where was all that money coming from? Think about pension funds. You have to make 8% per annum on these underfunded pension plans to be made whole. Well, you couldn't make 8% in a world of 0% treasuries and sovereign debt. What did you have to do? You'd had to go out on the risk curve and buy stocks. And then, you're buying stocks along, you're competing, the pension plans competing with the C-suite, buying stocks at bubble highs. The total market cap of GDP was 150%. Never before reached there, even in the 2000 tech bubble. It was never there. It's usually about 0.7% of GDP, so 70% of GDP. Then it goes to 1.5 times GDP. You're buying stocks back. These pension funds are buying stocks, and then all of a sudden the Wuhan virus comes along. It was a bubble looking for a pin, as my friend Peter Schiff used to like to say. Mm-hmm. So it was a bubble. I've called it a bubble for years, looking for a sharp object. It hits it, and it implodes. And now pension funds, their assets as a percentage of their liabilities, they were 50% before the Wuhan virus hit. And now if you look at states like Illinois, it's 20%, that ratio. And you ask yourself a question, wow, the Fed is buying junk bonds now. I never thought that And Mr. Fisher was probably very surprised, the former head of the Dallas Fed, very surprised we're monetizing trillions of dollars of debt and we're buying corporate bond ETFs. But now we hear that Janet Yellen, former Chair Yellen, is telling Congress, hey, we need to plan now, change our charter now of what we're allowed to buy, because we may very well need to buy stocks in the future.
Yeah.
How are you going to make a New Jersey pension plan, which is 25% funded? How are you going to make that plan solvent? Well, I hear people say, "We'll grow our way out of the we'll grow our way out." The tax base is eviscerated. There's no tax base any longer. I mean, why are we pretending you couldn't grow your way out of it before this? Now you're going to tell me that you've taken on $3 trillion in Q2 alone of debt that's completely unproductive, just handing money out to people, and that's your way of growing yourself out of the debt. It's not going to happen. We are going to monetize more and more of this debt, and that's why you're seeing, real interest rates. This is where real interest rates are headed. They're heading profoundly negative in the near future. They're already negative by several degrees, but they're heading, in my opinion, the most negative real interest rates the world has ever seen are coming globally. And
that's really injurious to the entire system. And it makes all the math not work anymore. When you have negative rates, it screws everything up.
Well, you see, the whole capitalist system, which is why I said that capitalism is eviscerated, is I'm deferring my consumption. So I'm saving deferred consumption because I'm investing, because I know my capital will have higher and greater spending capacity in the future. If you give me negative interest rates and it's inculcated in my mind that my purchasing power will be greater today than it will be in the future, then I'm going to go spend like a monkey. And that increases monetary velocity, and you get monetary velocity piled upon a huge increase in the base money supply, and that is your recipe for stagflation.
Yeah, it will definitely result in that. The question is, do we risk hyperinflation here? What's the risk of that?
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
Well, when you talk about hyperinflation, and just to show you that I'm not a hyperbolic person, it'd be easy for me to scare people and say hyperinflation. Well, if you look at hyperinflations through history, they all had one common component. Well, had many common components, but one of the necessary components was a collapse of the currency vis-a-vis their trading partners. So you have to make an argument that the dollar would collapse vis-a-vis the euro and the yen and the pound and the Japanese renminbi. The Chinese renminbi. So I can't get that in my mind. I can't understand how the dollar would collapse in value vis-a-vis the euro and those other currencies, other fiat currencies. I can make an argument, which I've said it before, is that we all look like Rome. Fiat currencies look like Rome. As you remember when they were debasing, taking silver out of the denarii and putting in, copper and tin, or whatever they could find that wasn't a precious metal. And that engendered inflation of 1,000% at the height. But it was around 250 AD in the Roman Empire. You saw inflation start to really pick up and the value of the denarii plunge, because people understood that the precious metal content of the coin was being attenuated. That's where I think we're going to have inflation. It's going to run into double digits, and I think it's going to be sooner than most people believe. And there's where the real crisis comes. That's when what I call the Greater Depression begins. So in the Greater Depression, this is the progenitor of the Greater Depression, an implosion of the bond market. which is the result of a combination of insolvency and inflation. So we already know we have an insolvent world. This is before the Wuhan virus hit. For example, corporate debt in the United States is up 25% on a run rate this year. Now, corporate debt was already at an all-time high vis-a-vis GDP, and on nominal terms. So we had $10 trillion in corporate debt, 145% of GDP. This is before the crisis hit. We're now adding at a run rate of 25% of corporate debt. We have insolvent debt, both on corporations and in the sovereign world. And when that insolvent debt meets double-digit inflation in the context of zero interest rates globally, that's the formula for a debt implosion. So you'll have bond yield surge, prices collapse, and there's nothing a government can do about it at that point, Kerry. They can either pursue the hyperinflation route and just burn their currencies and their economies into the ground, or they can step back and let the insolvency remain in the context of 0% and negative $17 trillion worth of negative yields. So, if you have a sovereign nation like Japan with a quadrillion yen outstanding, borrowing money at negative rates, and then I tell you that the BOJ is stepping away from buying JGBs. Where does that negative rate go? Not, it doesn't go to 1% or 2%. It goes to double digits, and it goes there fast.
Quickly, because
that's the real crisis.
Yeah, there's no buyers.
No buyers. There's no buyers at a who would buy if you knew that you weren't front running the Bank of Japan, as an independent purchaser of a Japanese government bond. If you knew that the Bank of Japan was no longer front running your purchases, why would you buy a negative yielding sovereign bond in Japan when the country's insolvent and inflation is double digit? Tell me why.
Yeah, well, because the government paid you to buy it, which is basically what happens here. And so implosion of the debt market, I think, I really do think, and not that I find all sorts of all wisdom and knowledge in the Bible, but certainly debt, having these debt bubbles, there's nothing new about it. And eventually it winds up in a jubilee, a reset, and everybody's debt becomes worthless, which is bad for the banks because one person's debt is another person's asset. But on the other hand, it's unsustainable. And I don't think I mentioned to you, but I created Lutz's law of unsustainability. And that is that an unsustainable trend will continue onward until, I should say a trend will continue onward, will keep going until it becomes unsustainable. But that it's going to be unsustainable in the future, and you're not going to know when it becomes unsustainable until it ends, and then it reverts, and then that's where we're at here.
Well, I have a 20 component model called the inflation, deflation, and economic cycle model. And that's pretty much exactly what I try to do. Instead of just guessing where the economy is eventually going to end up or drawing a line on a graph and putting a 200-day moving average, why isn't it a 199-day, Kerry? I never understood the difference. What is so magical about a 200? So instead of doing that, I try to make, markets into a science, sort of like a weatherman, measure and map using analytical data points. So I have 20 components that measure where the economy is going. What are break-even spreads doing, for example? What's LIBOR OIS doing? What's high-yield spreads doing? So a lot of that has been polluted by what the Federal Reserve is doing. But if you can send up these, weather balloons and find out, is the economy inflating? Are we growing? Or are we recessing? Are we entering into a depression? Are we deflating or are we disinflating? If you can get an idea where the economy is and where it's headed using those 20 components that I've developed and rigorously backtested, then when should I overweight bonds? Should I overweight bonds when we are in a depression? Yeah, that might be a good idea, because if you have deflation and depression, you want to overweight bonds. Should I have a lot of bonds when we're stagflating and hyperinflating or intractable inflating? That's a very bad idea. So you want to know what sectors to own, what style factors to own, based upon where we're headed. And if we're headed for stagflation, which, by the way, I'm 56 years old. I don't know if you want to share how old you are.
I'm 62.
But when was the last?
Okay.
Okay. So Well, so when was the last time anyone alive trading in this market experienced stagflation? Well, you have to go all the way back to the 1970s. So it's an anomaly that no one really knows how to trade. They're not expecting it, but it's something that every government in the world is vigorously pursuing.
Yeah, they
want 2% inflation.
Isn't it?
Exactly. What do they want? Yeah, they're burning themselves. They're lighting this world on fire. They've destroyed capitalism. What they want to do right now is encourage you to take on a tremendous amount of debt. Mm-hmm. And at the same time they're doing that, they're aggressively pursuing higher inflation. I think they're eventually going to win, and that means you will lose. Your investing audience will lose if they're not proactively preparing against it.
Yeah, I couldn't agree with you more. So, like you were basically saying, your theory of the market, what you were looking to do was to shield your investors from the inevitable crash. How did we do in March?
How did my investors do?
Yeah.
Is that what you're asking? So, I mean, I can't
exactly.
I don't know if I get in trouble with quoting specific percent returns, but we're absolutely up significantly on the year. If I quote a return, then I have to quote every return, which I'm glad to do because I'm happy about them.
Yeah.
Yeah. But we did very well this year. We're, trouncing the S&P 500, which is down on the year. We're up significantly on the year. So, but I don't want to get into specifics. But you asked the question. We're doing fine.
Yeah. So it worked. In other words.
Yes.
Because my feeling has always been like preparing for the inevitable is really difficult and usually doesn't work. But eventually it becomes more and more inevitable, and then you can do it. But it's like Mike Tyson, a plan is great until you get hit in the head, right?
Right. Punch in the face. Exactly. Yeah. Everybody has a plan until they get punched in the face. Everybody, I wonder if Mike Tyson ever thought that particular utterance would become ubiquitous. Gospel. Everybody loves that. Everybody loves that expression.
It's like the gospel. It's and like he's like a modern day Yogi Berra, when you come to a fork in the road, take it, right?
You take it. Yeah, I think we're dating ourselves now.
Yeah, but man, the yogiisms were priceless. And the other one was, prediction is really hard, especially about the future. You gotta love it.
He was great. He was wonderful.
And it's just like they're malpropisms and they're kind of silly, but they're so true, on a deeper level. And I think there's books out, The Wisdom of Yogi Berra. And maybe one day there'll be books out about the wisdom of Mike Tyson, although I haven't heard a lot more of his notable and quotables other than that one.
Well, probably a book about how not to tattoo your face.
Yeah, that could be a bestseller. That could definitely be a bestseller, Michael. Yeah, well, you know what? All we can do is laugh because the alternative is to cry. And I'm not crying.
Yeah.
Look, I did fine here. I got reduced a lot of exposure back in January and February, and not due to my genius. My partner pushed me to do it. And, I'm not saying that I'm going to be perfect in the future. I made a lot of stupid mistakes in the past. But this is an opportunity, though, because the playbook in advance, right? You know what they're going to do, and you more or less know how this is going to work out, right?
Well, you know what you say not to laugh. With 20% of Americans unemployed, so 1 in 5 Americans unemployed, and 30 million people filing for initial unemployment claims in the last 6 weeks, it's really sad. And every
it's a tragedy.
Stagflationary occurrence in history has started with, massive unemployment, dysfunctional economy, humongous, gigantic increase in debt that's monetized by a central bank. So this is not exactly uncharted territory for global economics. It is for the United States, sadly. And yes, we do know how it ends. But unlike most people, instead of just saying, this is where we're going to ultimately end up in X number of years, I try to make money due to this model during all cycles. Yes. But yes, you're correct. Eventually, I'm afraid that, we're going to see something that we haven't seen in 50 years. And it's coming sooner than most people think.
Yeah, really. And precious metals got to be your ultimate insurance policy, right?
Well, I mean, it's absolutely mandatory to own, 5% of your portfolio as a minimum in precious metals. And when you think about the progenitor of higher prices, you think about one thing. Even before the value of your currency, you think about the level of real interest rates.
Correct.
And if real interest rates are falling, and you have a central bank that's hell-bent on keeping them near zero, because that's the only way you maintain any semblance of solvency until you get to way above their asinine inflation target. And that's the very definition of
sorry, I didn't mean to
negative
laugh.
rates.
I totally know where you're coming from. That's why I'm laughing here, Michael. It's all we could do is laugh. So we know this game. We've seen it before. There's nothing new here, and we can go back to biblical times, before Christ, BC. I don't know if that's fashionable to say it. We've seen these collapses. They happen over and over and over again. There's nothing new here. I mean, we know this happens. And so here it's easier a lot of times than it has been a lot of times in the past. For instance, like when Nixon closed the gold window in 71, and that really set off an inflationary spiral. It was really difficult for most people to really grasp that, get their arms around it, because it was totally uncharted ground for the United States. But this time, it's really simple, isn't it?
Well, all you have to do is when you finish with this interview, anybody can do it. Just Google chart of the Fed's balance sheet. Just take a look at that, and then you'll know exactly where we were and where we're headed.
Yeah, that's such a great point. And where we're heading, if you're not prepared for it on some level, then what can we say? At this point, nothing should surprise you, right? Does anything really surprise you at this point, Michael? Anything?
Even the Constitution of the United States, which is what a beautiful document, is fungible, malleable, and ductile. So, nothing surprises me in times of an emergency. Anything and everything can and will happen. So, if you're still surprised about what happens, you're not paying attention.
Yeah, and desperate organizations. Well, you always have to remember the first rule of survival is every organism its first rule is out there to survive. And that doesn't matter if it's government or individuals or whether it's a protozoa, they're all out to survive. And they'll do it at anybody's expense. And the government will try to survive at the individual's expense. And it ain't going to be pretty, that's for sure. So I guess we're in for it here.
Yes, we are experiencing it right now. And unfortunately, I think there are even tougher times ahead.
Yes. Yep. So maybe we're getting a little reprieve right now because of the helicopter money, but don't expect it to last for that long. In any event, Michael, so best place to find your work and to connect with you on the web?
So the website is Pento Port, P-O-R-T, pentoport.com. You can come to the website. You can avail yourself of a free trial subscription to the midweek reality check. That's about 4 or 5 weeks free. And then it's only $49.99 after that. You get a high level view of what's going on and my thoughts, unique data points that you won't find on CNBS. And then if you want to email me, it's mpento@pentoport.com, mpento@pentoport.com. And the number here for the office is 732-772-9500. I promise if you call, we won't bite. We'll just explain to you the inflation, deflation, and economic cycle model. We have around $100,000 to invest. We'll take good care of you over here.
All right. Excellent. And that's a New Jersey number for now, but who knows in the future? Because the state government.
Well, I would call it escape from Governor Murphy. So, and his plan to balance the budget on the backs of the rich.
Yeah. Yeah.
But the rich are mobile, as far as I know, and you might be taxing, everybody who works at Stop and Shop to try to make the budget work, and that's not going to work.
No, capital goes where it's treated best, and that's why it's going from north to south in the U.S., why the South is rising, emerging.
Yes.
And that's a trend that's going to continue.
And you don't have to worry about getting snow in May. I don't think it snows in Florida in May.
No, it went down to about 68 degrees a couple of nights ago, and that was our polar vortex. So, anyways.
Well, great talking to you, Kerry.
Hey,
and thank you for having me on the program.
Always. And hey, if you got a question for Michael, you can send it to me, kl@kerrylutz.com, kl@kerrylutz.com. Make sure you go sign up for our newsletter, financialsurvivalnetwork.com. Michael, always a pleasure. We'll talk to you again real soon.
Thanks again, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.